Hello, today's Tuesday, March 1st, and we wanted to give a state of the options union before the state of the union later tonight. Now, on your screen in the blue line is the Bank of America Corporate Credit Spread Index, and as you can see, it is surging higher over the last several days. Now, this could be through a variety of reasons, particularly geopolitical, some of the concerns around the chain reaction regarding the Russian sanctions, and then off of that, there's also now a bunch of shifts in the expectations around monetary policy, the number of rate hikes, etc. The end result of all of this is credit spreads now have jumped higher, and that is a negative for equities. You can see in orange we have the S&P, and if we zoom back here, you can see that there's a big correlation between spikes higher in the credit spreads and declines in equities, almost similar to something like you might see in a VIX index. Now, with the credit spreads shifting higher, you note there's a lot of other. Now, with credit spreads shifting higher, you'll note that a lot of other asset classes are making quite a big move. Obviously, gold, crude oil has gone nearly limit up over the last several days. And then if you look at some of the U.S. government bonds, those yields are cratering as some of the rate hike expectations come down. Now, we're not going to dive into more macro. Our key point here is that these other asset classes are really moving quite a bit, and that will generally keep a bid into the VIX. And this is where the options landscape comes in. If you go to our YouTube channel, you'll see this video called "When the Put Controlled Negative Gamma Regime and When Will That End?" And we talked about in that video from last week that the equity market is full of put positions. And people are hedging the downside in equities, understandably, due to either geopolitical or monetary concerns. What is the Fed going to do, we think, is the primary driver of uncertainty right now in markets. And so if you watch that video, we discuss why put options invoke volatility in equities. Now, flipping back to today, in our morning note, and if you're interested in seeing our morning note, you can simply click the subscribe now button and get a free 7-day trial. We talked about the fact that the line, the negative gamma line, or essentially the line where we have a lot of calls and a lot of puts, is around 435 in spiders or 4350 in the S&P. And you can see that in the distribution on this chart. In the top red box here, you can see that there are a lot of positive bars on this chart, and that tells us that there's a lot of positive gamma. That's what these bars are indicating. There's a lot of positive gamma up above essentially the 440 line. And with that, if the market was to surge above 4,400 or 440 in spiders, we would get a reduction in volatility and a little more options dealer-based support. So below 435, really, we have a lot of put positions, and that's what these negative bars indicate. With those put positions come volatility and faster markets. So what's happening now is we keep getting this chain reaction. Headlines come out, and the market will rip higher or drop suddenly. And we believe it's this negative gamma position that's exacerbating the moves around a lot of these headlines that are coming out. Further, we have very short-dated options, 1 day's to expiration, 2-3 days to expiration. And the trading of those can also really whip the market around. In this environment, we don't think there's a lot of people who want to hold a material short put position because of the unknowns, particularly on the geopolitical side where you don't really know what may happen tonight or tomorrow. The risk of trying to sell a put that expires at the close is perceived to be lower. And so we get a lot of activity in the very short dated or same day expirations, and that can cause a lot of excess movement in the market. But essentially, the view is that anytime the market really rallies, it's driven by put covering. And so there's not much support. And again, we cover this back on this video here called the Put Controlled Negative Gamma Regime. Now, as far as today goes, we're going to show you our HERO dashboard. Now, HERO stands for the Hedging Impact of Real-Time Options. We just released a trial of this for our subscribers. And what's showing you is a view into the real-time options flow from a delta hedging perspective. So we're going to pull up the spiders here. And what you're going to see here are two lines. We have a black line, which is the S&P so far today. And then there's this purple line, which are the real-time deltas traded so far today. And what you can see is that as the market came down into 430 spiders or 4,300 in the S&P, while initially we had negative delta trading, at that 430 line, the options flow turned much more neutral. And what is that specifically? Well, if we toggle this, we can see that what we had is put buyers and call sellers to start the day. But again, on 430, the options flow has shifted much more neutral. And we can tell it's neutral because in blue we have puts and in orange we have calls. So when you see negative delta, that's telling us that people are selling calls or buying puts. And around 11 o'clock, that flow shifted neutral and has remained fairly neutral despite the fact that the S&P continues to drag lower. In fact, you can see there's actually a little bit of a bid in calls as it's drifted higher. Now, again, because of the major unknowns, that is the geopolitical and the monetary concerns, we don't think there will be major put covering anytime soon. And so this highly volatile regime is likely to persist. We think actually it could remain into mid-March when you have the FOMC and OPEX. But as far as today goes, even though we did move down pretty sharply into the 4,300 area, the options flow has backed off of wanting to short that even further. It shifted much more neutral to even a slightly positive stance. Now, if you shift to the Qs, it's a pretty similar setup in that we've had a pretty neutral day from a flow perspective. There was one big sale of Q calls here, and that's what this big sharp line lower is indicating. But overall, the options deltas really aren't suggesting that there's a material change in options positions for today. We think what this is characterized is just by the fact that there's no reason for heavy volatility selling to come into the market because, again, of those unknowns. And consequently, people want to own some downside demand. And there's pretty weak upside demand in the form of call buying, at least from an index perspective as well. So in summary, the market still remains under the control of put options. We're going to continue to have this very volatile regime until the unknowns become knowns. So we hope this video is helpful. If you have any questions, please put them in the comments or send us an email at info@spotgamma.com. Thanks.